Sejam bem-vindos ao Papo de Crédito. O Papo de Crédito é o blog da Brava Capital, onde nós disponibilizamos vídeos com entrevistas e artigos que possam ser do interesse de empresários brasileiros e também de investidores que tenham foco no mercado de investimentos alternativos brasileiro. Hoje eu estou aqui com o Erik Mayo. O Erik Mayo ele é o Sócio Diretor de Investimentos da gestora de recursos americana Terra Incognita. O Erik é um investidor ativo com foco em mercado internacional, principalmente nas áreas de crédito, trade finance e private equity. E ele também empresta sua expertise em finanças empresariais internacionais, participando de conselhos em empresas com e sem fins lucrativos no Brasil e Estados Unidos. Antes de fundar sua primeira empresa de gestão de recursos, Erik ajudou a gerenciar os ativos de fundos de hedge na Universidade de Stanford, nos Estados Unidos. Ele começou sua carreira atuando nas áreas de gestão de risco e sistema de negociação para o Deutsche Bank após a sua graduação na Wharton. Seu interesse na convergência entre finanças e tecnologia o levou a ser um investidor ativo de risco, hoje, ou como se diz em inglês, um venture capitalist. Obrigado, Erik.
Thanks for having me.
You're welcome. Erik, just going, for the first question today, how are international investors viewing the current environment in Brazil from a macro standpoint?
From a macro standpoint, folks are a little bit worried, but I think it plays on a very similar theme coming out of the U.S. that you've generally seen in the emerging markets. Brazil in the last year, coming through the crisis and impeachment and everything else, people were like, oh, the emerging markets, they have a lot of political risk, especially down here in Brazil. What's interesting is people are beginning to see that in what they consider their safe markets in the developed markets. The U.S. has Trump and uncertain policy, in trade. You've got Brexit affecting the EU and Britain. The EU also has Greece, which is the problem that goes away and comes back every year. And then you've got elections in France and other places, and you're beginning to see more populist policies come up in these countries, and those policies are generally similar to some that you may have seen, not necessarily work out so well in the emerging markets.
So would you say that it's not like a peculiar problem in Brazil? Would you say that the political instability is taking place all over the globe?
I think it's taking place all over the globe, but it's not quite yet priced into the developed markets.
I see what you mean. And wouldn't Brazil be just a little worse than the other places you have mentioned?
I think from the international investor standpoint, because of its history and its ups and downs, I think it's viewed as being a little bit worse. I think actually having been through some tough times and seeing the market get a little depressed, valuations make it not as bad relative to some of those other markets that you've seen. I mean, the U.S., the stock market is trading at all-time highs.
Would you say that foreign investors are scared of the currency?
They're very scared of the currency. With Trump's election, you've got increased U.S. interest rates, you've got, bond yields in the U.S. in terms of treasuries moving a lot, and you expect a stronger dollar. And so I think people are worried if they're making investments down here about how they'd be able to hedge them and the cost of hedging. I think it's a huge worry for a U.S. investor.
Okay. So how all of this will affect the private equity sector in Brazil?
I think it's one of the areas you find that U.S. investors are very excited about. They look at the valuations because of depressed earnings being good. The low currency means things as they're priced in dollars are cheap. And for the first time in a long time, you've got entrepreneurs and business owners who are a lot more flexible around pricing and giving up control. here, because you still find international investors not wanting to make minority investments down in Brazil. So I think that's become important. So private equity is I think you'll find a lot of interest coming from the U.S.
That's good for all of us to know. Do you see any opportunities in the credit sector at the moment?
Yeah, I think the high yields here are always interesting, especially since they're high real yields. I think a lot of investors are worried about the potential illiquidity and the legal system here. I think personally, I think a lot has been done over the last decade in terms of the legal system to make it a little bit easier, and the fiduciary lien and other things.
Executions, bankruptcy, laws.
It's helped a lot, but I think you can eliminate a lot of that risk by investing in strategies like factoring and trade finance. They're relatively short durations, so you don't have to worry about any of the long-term political risk. You can be very diversified, so any of the credit risk in one single company doesn't have a huge effect on your portfolio. It really, and then again with that litigation risk, when you're not, it's a little bit of the law of lend me a little bit of money, it's the company's problem, essentially. Lend a company a lot of money, it's your problem. And so, with the factoring, you can lend them a little money and not be worried so much about getting tied up in long-term litigation, because it's a lot easier to pay you off.
So Erik, it's you mentioned factoring here today, and I know that you have invested in that segment before. We have seen some funds going bust, doing really badly. We had like the Silverado effect, Union in the past, Porto Forte, and Oboe and the other guys. So what type of structure would you look for when you consider investing in the factoring business?
So I think about this comes with what you see a lot of U.S. investors doing when they come down here. They look to invest in the biggest thing and the branded thing. And I actually think that creates a misalignment of interests, because it becomes, for those fund managers, about earning money off of the management fee rather than the performance of the portfolio. I also think it's not just being invested in their fund, but because these funds have associated companies, it's in investing in a structure where you're participating in everything. So there's not an incentive to move around assets or move around money to, play with fees and expenses and things. Be in a structure where everyone's aligned and everyone's making money off of the same thing.
Okay, I see. So what do you think about lending structures where you have Brazilian real estate as collateral at the moment? How do you see those?
I think it's a good structure. I mean, real estate, again, you're getting in at a relatively low valuation. So it's good, and hopefully your collateral will appreciate over time.
Not in the 50 states, because we don't have 50 states anyways.
Yeah.
But maybe in the in the best areas.
In the best areas, I think it'll do that. And real estate, again, with the fiduciary lien in the good areas, it's not like you're going to get off in 30 days, but you should be able to get out of that property in 3 months, 6 months, a year, to really get your money back if you have to foreclose on an asset.
Okay. So do investors also see credit opportunities in the peer-to-peer market in Brazil? Peer-to-peer lending?
Sitting up in San Francisco, I get calls about this on a fairly regular basis. People have made money on peer-to-peer lending in the U.S. and the U.K., and they're really excited to try to expand to other markets. And Brazil is one of the first they look at, one again because of the high yields, but because it's also big enough. You know, you've got 300 million people, you've really a big lending environment. So I see a lot of companies looking at trying to find a way to come down here and do peer-to-peer lending. I worry in the fact that they're technologists. They're not necessarily lenders. They're definitely not lenders here. Mm-hmm. And so they don't understand the regulation, the structures, myriad of things that they're going to need to do to be successful and, not end up fined or in jail for doing something.
Yeah, in some of these cases I've seen lawyers setting up those companies and people who, actually don't have much experience in the credit sector, right? And when they try to make those companies and people lend money to one another, they lack lots of information that are critical for proper credit analysis. I don't know, it's just something that I don't understand. I've had some of those meetings also. It doesn't really work up in the US because in Brazil it seems to me, that's of course my opinion, that it would be a little hard working here. Has it been successful in the US?
It was successful when it was what I would say is a small scale and it was really peer-to-peer. So it was you and me as the individual, essentially funding other loans. But when institutions, hedge funds, pension funds started pouring money into the sector to make loans, you got an origination problem. And essentially, in my opinion, they're recreating the subprime mortgage crisis in, unsecured consumer credit. Because basically, you've got the banks who used to do these loans, and they used to make credit cards. Well, think of them as your mortgage lender. And then came in Fannie and Freddie, and they took off all the good borrowers on the top. And so that's essentially how all these peer-to-peer lenders started. They're like, we're going to lend to the A credit quality borrower who pays back, who's paying 15% and should be paying 6 to 8 for his loan. And so that's the loans they were originally making. But then they got more and more money and more money, and they're like, well, there are only so many of these people. And so now we've got to get these borrowers and go down, but we'll charge a higher rate. But if you look at it today, they're originating loans in actually in an environment that has the lowest credit card defaults in 10 years. They're originating loans at 25%, where your net return is 7 to 9.
Wow.
And that's on losses, servicing costs, defaults in a benign credit environment. So I can only imagine if things get a little bit difficult in the US, it's going to be a nightmare and there will be lots of losses. And I see it as being worse here in Brazil because you don't have the granular credit data. The borrower is a lot smarter about renegotiating their debt and managing the credit system and the laws than I actually think than the average U.S. borrower. Having been down here and done some investments in consumer distress, so I don't think it's going to work quite as easily as people think.
How do you compare? When you mentioned the credit card sector and how they are lending money, how do you compare that to the causes that brought us to 2008, the credit crunch?
Well, it was all about origination for structured bonds. So it's about getting more and more bonds and you can't originate more loans. There are only so many people who fit certain credit criteria at a certain interest rate. And at some point, you have to lower your credit criteria to get more borrowers. And what happened in the US is they just kept doing it and doing it to really feed their, bond, so they could stick them in bonds and sell them. And you're already seeing people do this for peer-to-peer loans in the US. And so it's exactly the same thing. Oh, we start with doing things for the good borrower, and then we structure it in loans and we sell it. Oh, but we need more of it because people want more of these bonds. Oh, so we go down in credit quality to the lower borrower. And we get more and more of them, but we're using, because we don't have good data on these people, we're going to use models that we had for these people, but they're not, tweak them a little bit, but they're not really right. And we're going to stuff them in the bonds and do more origination. And then at some point, housing prices stopped going up and went flat. And it all turned and people started taking losses. They started going down. People started taking losses and you got a big credit crisis. You're going to see this in means, because they're like credit cards, they're unsecured loans, so it's worse. Mm-hmm. So instead of getting 60 cents on the dollar,
you're gonna have a piece of real estate, a house to collateralize it.
Yeah, when you do your workout, you're going to get $3, $5 dollar, and it's gonna be really, really bad.
All right, so Erik, I'm aware that you've been in Brazil for maybe 2 weeks, close to a month, right? So I would like to ask you, why Brazil? I mean, it does not seem to be the most obvious investment destination these days. So why are you spending time in Brazil assessing investment opportunities?
Historically, where some of the best investments I've made over my career is places coming out of crisis. Mm-hmm. If you looked at, Asia, post the Asian crisis, we did a lot of investment while I was at Stanford in distressed debt. Mm-hmm. And those were great. And then you had Enron and WorldCom and Global Crossing. And again, so that ended up being U.S. distressed debt. A few years later, when I was at Fitton Partners, you had 2008 and the mortgage crisis. And so then it was a great time to go in and buy distressed mortgage loans and structured securities. We made a lot of money there. And so I look at, the best places to make money are places that are generally coming out of crisis where you've got undervalued assets. And so coming and looking at Brazil is trying to figure out, well, what is the right asset? Where are those assets? What are the differences in the laws so that you understand where to invest and who are the good people to look to partner with on those investments? And that's why I'm here, but it's always remembering, yes, there's risk, but where there's risk, there's also return.
Okay. Based on our conversations during your time here, I have noticed that you are a little disappointed with the investment industry these days. So what's wrong with the investment industry today for you? And why do you see so many fund managers or funds underperforming? And why has it been hard to find funds with attractive returns?
Well, it comes back to a little bit of investors looking for big size and seeing that as a risk mitigator. When I started my career in hedge funds, unless you were a macro fund trading rates and currencies, a $500 million fund was big. And in fact, you used to try to write into your investment contracts that they would cap the size of their fund and not raise any money when they began to get that big. Today, a $500 million fund is considered an emerging manager. They're not of institutional size yet. Well, when you get big, it becomes very hard to exploit, mispriced anomalies in capacity-constrained strategies, which is really how the hedge fund industry started. You look at other things that have effects too. When I started, rates were, in the U.S. were about 4%. It's down here like 19. Today, rates, in the U.S. are, less than 1, and they're 13 here and going down. So that affects, because generally you're making a spread over the risk-free rate in your investments. And then the other thing is, just volatility and the amount of risk investors are willing to accept as it's become more institutional has lessened. And so you used to run your hedge fund strategies at about half the stock market vol, and I bet to say that you're probably running, for most funds at risk, that's half of that today. And so if you take a strategy that might have had a 12% return, you take off that 3% for, lower interest rates, at least in the US, then you take off, okay, well, we're taking less risk and less vol, and the sizes of our funds are bigger and there are more people chasing those anomalies, so, the spreads you can make in those are lower, and suddenly you end up at the low returns you see today.
Yeah, it doesn't seem like rocket science. It sounds obvious when you say it, right?
Yeah, but for some reason people don't really see that, and so they still go for the large manager and don't find ways to fund smaller managers, keep them, in their capacity constrained strategies where they can earn those outsized returns.
All right, thank you very much for your time. I expect to see you soon in our Papo de Crédito. Okay? Por favor, sigam o nosso blog e se inscrevam em nossas páginas no LinkedIn e Facebook. Muito obrigado.